Why is it that interest rates in America rose so high and so fast, and yet recession is in no sight and economy is still very resilient? Well, there are several reasons behind that, but the main one is the government. US government is single-handedly upending the US economy and staving off the recession. It may seem that it is good for American economy and American consumers. However, of course, there are caveats. There are costs attached to what American government is doing, and that is the topic of this video. We will talk about how American government has managed to outsmart the Fed and therefore synthetically prolong the monetary cycle and stave off the recession. American Federal Reserve and other central banks in the Western economies have significantly tightened monetary policies over the last year in order to fight the inflation that themselves and the Western governments have caused by printing the money to stimulate the economy in reaction to the pandemic. Now, to achieve that, they must weaken the economies that are currently running hot, especially in the United States. And one of the main problems is the wage growth. People are requiring higher wages for their work due to record profits that companies have recorded in the past years and due to the rising living costs. It just makes sense from their point of view. However, it has been a long time already and the economy is not slowing as expected. During the past monetary cycles, economy tended to slow significantly faster than during this cycle. However, as mentioned at the beginning of the video, there are special conditions that make this cycle very different and unique. And that has to do mainly with the amount of money that was printed and that is still being spent by the US government to stimulate the economy. This is why I said that government is playing against the Federal Reserve and is preventing the US economy from falling into the recession, at least for now. At the beginning of July, when the debt ceiling drama finally resolved in the United States, the federal government communicated its intention to refill the Treasury General account, which is essentially the government's bank account that it uses to finance all the expenses that it has, of course by issuing new treasuries. Since then, the Wall Street analysts have estimated that US government will attempt to issue approximately $1 or $1.2 trillion worth of new debt. And currently the government is halfway there. Current Treasury General account sits at around $670 billion. Many analysts have also forecasted that this new issuance would siphon the liquidity out of the system, including the stock markets, which could lead to some form of correction. However, this has not happened. Since July, the stock markets continued to rally, of course, until August and September, which are statistically the worst months in a year for the stock market performance. However, if you measure the liquidity in the system have in fact not changed. Actually, it tended to increase a little bit since the issuance of new treasuries has begun. But how did the government do it? How could they issue such an amount of new treasuries without actually affecting the liquidity of the United States? Well, they used this one smart little trick. They siphoned the liquidity mainly from the reverse repo markets. For those of you who don't know, the reverse repo markets are the overnight operations permitted by the central bank, where huge institutions such as pension funds or banks, etc., are allowed to deposit their money to earn a short-term interest on their deposits. Before this new government treasury issuance, there was more than $2 trillion worth of deposits on reverse repo markets. The US government knew it, and they have cleverly tapped into this resource. They have approached the institutions from reverse repo markets and offered them the treasuries, more specifically T-bills. These bonds usually expire in less than a year, and they have offered them yield on those T-bills that was slightly higher than what those institutions could earn from reverse repo markets. Otherwise, there would be no incentive for them to buy those treasuries. So US government has cleverly used the liquidity that was lying at RRP market, and that is why the liquidity in the overall American system was basically untouched. And the stock markets continued to roar until the end of July. It would not help the Democrats nor the President Joe Biden if the recession came just before the elections in the year 2024. Data show that if the recession hits, the government ruling the country at that time will have harder time to be re-elected. Nevertheless, it doesn't change the fact that there are some consequences that the American public will have to bear because of what the American government is doing and how it spends the money, even though there's no apparent need to continue in such a spending. First of all, the RRP is not bottomless. Currently, it sits at around $1.4 trillion, and it is already around $800 billion less than it was before the government started tapping on this resource. Secondly, there is certain thing that is called the debt mix. There's a recommended debt mix that governments should follow. Therefore, the US government cannot issue just the short-term bonds or the T-bills, because that would cause imbalance in the debt mix. Ideally, government should diversify its debt across the yield curve, which is not what it is currently doing. Around 1/4 or 1/5 of the government debt is backed by T-bills. It means the bonds with a short-term duration less than 1 year. If what I said is true, it means that in the future the government will need to stop issuing the T-bills only and diversify into the longer duration bonds such as 10-year bond, etc. The increased supply of the 10-year bonds on the markets will of course lead to the higher yields, which is bad for economy and stock markets. I think investors are actually predicting this, and that is why currently the yields are growing and 10 years sits at 4.5%. Not only this, there's also a greater problem that this creates, and that is the inflation will not go away because of all of this fiscal stimulus. This may lead the Fed to hold the interest rates higher for longer than necessary, and it even may lead to the second round of tightening where the Fed could raise interest rates up to even 7%. That would happen if economy remains strong and inflation doesn't trend down to the 2% target. In conclusion, it seems that the US economy is being artificially upheld by the US government, pumping liquidity into the system, and that might explain why stock markets since the beginning of the year were roaring higher and higher, even though the macroeconomic situation doesn't really support this bull rally. This may spell trouble into the future as US government starts to issue more of those long-term government debts, boosting the yields on the 10-year treasuries and worsening the liquidity situation. In such instance, it would not surprise me if markets were to crash down another 20%, because that is exactly what happened in year 2022. In the first half of this year, the RRP, the repo reverse market, started to fill up, and the Treasury government account started to fill up too. Both of these factors, in a matter of few months, siphoned around $1.5 trillion out of the system. That is a lot of liquidity that was taken out, and the markets felt it gruesomely. I'm afraid this situation may repeat itself in the future. That is why significant cash position in this environment is one of the best choices in my opinion.